Good morning. This is the California Mortgage Bank Association Mortgage Quality and Compliance webinar for April. Thank you for joining us all. I am Ray Schneischerveld, the chair of the Mortgage Quality and Compliance Committee for CMBA this year. So thank you everybody for joining. Today we've got quite a good schedule, doing some of the things we usually do, and then we get to see hear the updates on federal and state law. What I'd like to open with is introduction to, I think everybody knows, Jeff Flory from the Compliance Group, our sponsor for the year. So thank you, Jeff.
Thank you, Ray. The Compliance Group is very proud to support the efforts of the California MBA, and in particular to sponsor the Mortgage Quality and Compliance Committee this year. It's anticipated that the new and improved CFPB will be much more active in the coming years in the forms of increased enforcement actions, rule promulgation, and this makes the work of this committee so vitally important as it provides timely and relevant topics to help lenders protect themselves and ultimately the consumers they serve. Now, the Compliance Group is celebrating its 21st year serving clients nationwide in 3 core areas: quality control as an outsourced solution, servicing quality control, and broad-based compliance-related services. Now, our mission is to create highly engaged partners by supporting their efforts in effectively managing their compliance and quality risks. Our team of highly knowledgeable, meticulously thorough, and passionate associates are focused on creating exceptional experiences with every interaction we have with our partners. And Ray, if you'll indulge me for just one more moment, one of the other things that I and the California MBA staff are very, very passionate about is advocacy, both locally and nationally. And together we have a much stronger voice and can make an impact on our businesses. So if you haven't already, please join the Mortgage Action Alliance by visiting the MBA's website. And while we're obviously going to hear from Pat shortly, there's also an advocacy section in the California MBA website as well for some real solid information. Thanks for tuning in today. Ray, I'll turn it back to you.
Thank you, Jeff. Greatly appreciate that. Great kickoff actually for today's session. So I appreciate that. Next up, oh, by the way, this webinar is being recorded and is available on the MQAC website as well as the YouTube channel. So if you missed it or want to hear it again, or there was something fascinating that maybe I said, doubt that you want to hear again, just to go back and listen to the recording or let other people know. So we don't want anybody to miss out on the information. Next, I want to introduce, of course, is Pat Zenzala, who's been with us for a long time with CMBA. Going back to what Jeff is saying, I think it's very important that things don't happen automatically. Laws and regulations, and especially with the things that we do, you sometimes wonder how it happens. Well, I guess Pat Zenzala is lucky enough to see how the sausage is made, but he always needs input from us, and I know that. I've worked with him for many years. So with that, Pat, you want to give us an update and coach us through this?
Sure. Thank you, Raymond. First bill I want to talk about is AB 948. It was recently amended, and it's designed to deal with some problems with appraisal discrimination based on race. We've seen some press on this topic nationally over the last few months, and so the author is trying to address that. Basically, what he's doing with the bill is requiring that if you have any sale of real property, the contract for that sale includes a notice to the buyer that the buyer is entitled to an unbiased appraisal of the property, and that the appraisal is designed to be objective, not influenced by any improper or illegal considerations. And then it must include information regarding reporting any biased appraisals. So it would be required with the sale of the real property, but then also the bill would require any mortgage lender that's doing a loan or refining to also provide that same notice to the consumer. So that's one issue that we're looking at because it was just amended. We don't have a lot of feedback on it, but obviously this is a very sensitive issue, and we'll be looking at it over the next few weeks. The next bill, SB 373, is one that we've been working on for a while. This bill would amend the California Rosenthal Act, and it would prohibit a debt collector from collecting or attempting to collect any consumer debt if the consumer provides documentation that the consumer was the victim of economic abuse. And the issue and the concern that we have with this bill is that it has some very broad definitions. As an example, there's a very broad definition of economic abuse. Also, there's a broad definition of what's considered to be sufficient documentation. Essentially, sufficient documentation could be any document provided by an attorney or by a counselor, as an example, or social worker, just stating that the person is the victim of economic abuse, and then you would be unable to collect on that debt. And most problematic is under the Rosenthal Act, consumer debt would include mortgages. So obviously this bill is of concern. We're trying to work with the author because this is, obviously we want to help victims of economic abuse. Given the complexity of it, the author has agreed to make this a 2-year bill, which means that he's not going to pursue it this year, and that if he wants to continue to move it, it would move in January of 2022. And we have agreed to continue to work with him over this year to see if we can come up with a compromise. The final bill I want to mention today is SB 449. This is a bill that would originally required mortgage lenders to provide a annual climate assessment risk. So basically any lender would have to put together, state licensed lender would have to put together an assessment of the climate risk relative to their products and services. We oppose that bill. We think it really doesn't make a lot of sense, especially for residential 1 to 4 mortgages. And the author has actually moved away from specifically focusing on lenders, mortgage lenders, et cetera, and now is applying that requirement to any company or entity that's licensed to operate in California or has a certificate of authority in California to operate. Most importantly, though, he's dramatically reduced the impact because it would apply now with recent amendments to entities that have revenue of at least 500 million annually. So definitely focusing on larger entities. But he's also looking at amendments that say that if an entity is already complying with federal requirements with respect to providing an assessment of climate risk, that would be sufficient to meet the requirements of the bill. So we're looking at this, we're looking at the proposed amendments to see what impact, but we think the impact is dramatically reduced as far as California MBA members based on the recent amendments. So those are the issues, Mr. Chair, that I wanted to highlight today.
Well, very good. Thank you very much. Out of curiosity, what's the feeling out there now that it's coming out of COVID? Anything different? Is it going to be more servicing, anything like that? What do you see as the main issues?
The main issues, I'm sorry, for COVID related issues? Or?
Not necessarily COVID related, but now that we're coming out, anything from that? Is it something, is it really more the debt relief bill? What do you see?
So I think right now, the thing that concerns me most is if we see a resurgence at all of the virus, or if we see a resurgence of consumers that are unable to make payments on their mortgages. I could very easily see legislation introduced again this year to try to mandate forbearance requirements and or to put essentially an end to foreclosures for some limited time frame. So those are possibilities up until September when the legislature adjourns for the year.
Okay, very good. Thank you. Thank you, Pat. We love the updates. We'll see you, I guess, our next show next month. Thank you. Next, let's transition into the main event. Keep in mind, we have the ability to do Q&A through the chat box if you see that. So if you have any questions along the way, please put something in there. We'll monitor that and we'll address them after the presentation. So let me introduce our speakers. Today we have Mike Flynn from Buchalter. He's a member of Buchalter's Commercial Finance Practice Group and Mortgage Banking Group and co-chair of Buchalter's Financial Services Regulatory Group. And it's the Title and Escrow Industry Group as well in the LA office. Mike applies his unique background as a former acting general counsel of HUD and the formal general counsel of PNC Mortgage and Flagstar Bank, to counsel clients on a variety of regulatory mortgage, consumer financial services, fintech, and real estate matters. Michael also serves as a vice chair of the California MBA's Legal Issues Committee. So thank you, Mike. I will also introduce our co-panelist with Mike. That is Scott Brooks, who represents Quicken Loans, a family of companies, as a director of government affairs for the Pacific Northwest. Scott advocates for the company's government agenda through regulatory and legislative activities. He joined Quicken Loans back in 2013. He currently serves on legislative and advocacy committees for Nevada and California Mortgage Bankers Association and the Arizona Mortgage Lenders Association. His focus has been in fintech, specifically on data privacy, data security, blockchain, and other associated issues. So I can see we have quite the esteemed guest to bring us into this issue. So thank you, guys. With no other further ado, take it away.
Well, thanks. I'm going to go first and talk about recent changes to the CFPB, where the CFPB is going right now. Then Scott is going to talk about the former Department of Business Oversight, now the Department of Financial Protection and Innovation in California. And before I get started, I just want to thank the committee and the CMBA for asking me to participate in this program. Buchalter has been a active party working with the CMBA for a very long time, and we're always happy to help provide updates. And I also wanted to add, I've had the pleasure before of working with Scott on matters, and you're going to benefit greatly from his insights on the state matters. He's very well informed on these issues all across the country. So if we can go to the next slide. Thank you. A lot has happened with the CFPB just in a few months since the inauguration of President Biden and the new administration, because of the administration's focus and the people they put into the Bureau. The administration has had a strong focus on a number of areas that relate to mortgage lending. Compliance generally, and by that I mean they have a strong focus now on you have to be complying with rules, I think stronger than they were the last few years, and they're looking at it more carefully, they're examining more carefully. Much stronger emphasis on fair lending, which we'll talk about in more detail. Much stronger sense that there's a perceived need for more rules and oversight across the consumer financial services area, including mortgage, and we'll see some of the things they've been doing in mortgage. A definite campaign to unwind Trump-era rules and guidance, which we'll highlight. And then some new areas that I think are of interest to mortgage lenders and servicers. Fintech, debt collection, and COVID crisis issues are all things the CFPB is clearly focusing on now. Let's go to the next slide. In terms of personnel, the acting director, Dave Vuigio, I probably mispronounced his name, and if I did, I apologize. He's been at the agency for almost a decade, and he has not been acting as a typical acting director, sort of holding the fort down. He's been very aggressive, perhaps not aggressive is the right word, very active, not only in terms of a lot of things they've been doing with guidance and rules, but also in staffing up. And they've had a strong effort on recruiting for mission-oriented lawyers to help achieve the agency's priorities. And mission-oriented lawyers oftentimes means enforcement lawyers. So they are hiring up enforcement people, and we can expect to see more of that. Rohit Chopra has been nominated as the permanent director. He's expected to be an active director. He is currently at the FTC. He can't come over yet because of some administrative maneuvering where they need to get an FTC position filled first before he can resign. But he will be presumably not approved by the Senate very quickly and will take over. He will continue doing what the current acting director has been doing in terms of keeping the agency very aggressive in a number of areas. Let's go forward. All right, first let's talk about what they did to undo all the Trump era rules and guidance. There was a lot of feeling amongst the Democrats that the Trump administration's CFPB was somewhat inactive. That's not necessarily true. They did a lot of things. They just did a lot of things the Democrats didn't like. And so those have been unwound and very quickly. As an example, they started off with a number of things they did largely related to COVID to ease burdens temporarily on lenders and servicers to make it easier for them to work with their customers and not get caught in the loopholes of very precise servicing laws and things like that that might get in their way. Those have all been pulled back. Starting with the statement on Bureau supervisory and enforcement responses to COVID back in March a year ago, that was issued by a group of all the banking agencies and the CFPB instructing regulated entities that they should be focusing on assisting consumers and other borrowers, providing forbearance, that sort of thing. That has been revoked, and the CFPB is now saying just follow all the rules. It's perhaps a sign of a little less cooperation with the other agencies, which we'll get to later in regard to some COVID remedies. I don't want to go through all the rest of these. I think you're probably fairly familiar with them, but if we'll go to the next slide, you'll see there are seven more, which shows how the CFPB has been pulling back from this temporary easing of regulatory requirements to assist people during COVID, and is now expecting full compliance with all rules, in the belief that lenders and servicers have been going on long enough with COVID, and COVID is easing enough that they can do this while still providing full protections to all people who need COVID protections. Let's go to the next slide. Continuing, I think we can expect them to continue whittling away, as we're going to talk, for instance, in regard to QM. They're going to whittle away at more Trump-era guidance. That's a likely focus going forward. In particular, we're going to see more in regard to fair lending, I think, QM rule, COVID-related issues, which we're going to talk about, FinTech and debt collection, which we're going to talk about. Let's go to the next slide. Fair lending. In January, one of the first things President Biden did was to sign an executive order directing HUD to address racially discriminatory housing policies in order to advance racial equity. In practical terms, this meant HUD was supposed to look at two rules that the Trump administration had put in place, unwinding prior rules and getting rid of the new rules and essentially going back to the old rules. So in 2013, HUD had issued a discriminatory effects standard for disparate impact rule analysis under the Fair Housing Act. That was replaced by a Trump-era law in 2015, which was purportedly drafted to address the standards created by the Supreme Court in the Inclusive Communities disparate impact case. That new rule, 2015 rule, was enjoined by a court, and then now the CFPB has submitted to OMB for review a rule reinstating parts of the original version of the rule to address residential segregation. Oh, I'm sorry, that's a different rule. I'm sorry, they've submitted a new rule to CFPB, to the OMB, to essentially go back to the 2013 rule with the stricter standard, which would have an impact on litigation, enforcement oversight of fair lending and issues like that. Also, HUD had an older rule requiring cities to address residential segregation in certain ways with very heavy reporting requirements, analysis requirements, working with outside consultants. The Trump administration had issued a rule making that somewhat simpler. That is going to be in part stripped away, and the parts of the old rule, key parts, are going to come back in, putting more requirements on local jurisdictions to take steps to and to show they have taken steps to address fair housing and equal access to housing in their, especially affordable housing in their communities. Additionally, the CFPB recently issued an interpretive rule clarifying that the ECOA discrimination protections apply to sexual identity, gender identity, and other sex-based or gender-based stereotypes, associations, and preferences. All of these things together, happening so quickly, are a clear sign of where the Bureau is likely to go in being even more aggressive and more assertive about fair lending and fair housing issues. As they dig into this more, they'll probably do some more rulemaking, and it's a sign that all of you need to really be on your games, or advising your clients to be on their games about fair lending analysis, reporting, and issues. Let's go to the next slide. The QM rule. If any of you are involved in underwriting and originations, you know the problems here. The Trump era rules redefine the QM definition, removing the 43% DTI limit, and created a new category of seizing QM for QMs that are held longer by the originator or original buyer in the secondary market. The CFPB has been very active in this space. They apparently don't like those rules very much. They have issued a notice of proposed rulemaking to postpone the July implementation of the new QM definition to October 2022. That's clearly designed to provide enough time for them to study this more carefully and probably propose a new rule redefining or going back to the old definition with a DTI limitation. I think a lot of people who are consumer protection focused were very concerned about the elimination of the DTI provision, as they feel that that's a trap a lot of borrowers got into before the last financial crisis with loans that were just too rich for them. It's considering whether to initiate a rulemaking to revisit the seasoned QM final rule and whether to even revoke it. And they are also considering at a later date whether to initiate another rulemaking, as I said, to reconsider changes to the general QM rule. In other words, the QM rule status is way up in the air. The CFPB is clearly going to do something. They moved as fast as they can on this, and we can certainly expect more soon. Let's go to the next slide. Enforcement and UDAAP. During the Trump era, the CFPB issued a policy statement indicating how they would handle UDAAP issues, particularly abusiveness issues, which a lot of people feel is not well defined. They indicated they would not impose civil money penalties when companies made true good faith efforts to comply with the law and tried to define better how they interpreted abusive. The CFPB has now revoked that policy statement. They said, this interesting quote, going forward, the CFPB intends to exercise its supervisory and enforcement authority consistent with the full scope of its statutory authority under the Dodd-Frank Act as established by Congress. Well, what does that really mean? Well, before the Trump era statement came out, the CFPB was renowned for doing regulation by enforcement without any limitations on how it looked and applied abusiveness in any context, and with the full range of penalties available. They quite openly admitted they were regulating by the threat of enforcement, and that public enforcement actions, consent orders, helped to define the scope of what you were allowed to do without providing actual rules for a lot of this. It has a tendency to be more restrictive than a rule because everyone's afraid to get anywhere near the results of a bad consent order. So they tend to hold back even farther. And the CFPB has reverted to that, appears to be reverting to that position and being willing to do regulation by enforcement going forward. That's a very aggressive posture for the agency, and we're likely to see more of it. Let's go to the next slide. In regard to COVID, they've been very active recently in just the last couple of weeks. And it's interesting because they're moving into an area that was previously addressed by the states. The states had largely been the ones that dealt with foreclosure moratoria, eviction moratoria, forbearance issues, along with Freddie and Fannie. The CFPB had just stepped right in without any explanation, without any really serious explanation, I think, of why they think they need to be there, or why these other entities weren't doing a good enough job. We've now had foreclosure moratoriums for a year, and all these other entities keep extending them as needed. Not really clear why the CFPB felt the need to intervene, but it did. It's probably an example of how this current CFPB regime views itself as being the ultimate protector of consumers, and that it must assert as much authority as it believes that it has in virtually every area. Let's go to the next slide. With that in mind, what they actually did recently was issue some rule changes. And what it actually does is that these affect foreclosures to where, because of it's a proposed rule, and we just have to see what's going to happen with them. They're saying that there's going to be a special pre-foreclosure review period that would generally prohibit servicers from initiating the first notice or filing of any sort of foreclosure until after December 31st. So they would be unilaterally extending foreclosure moratoriums from what's generally in most jurisdictions right now, June 1st or July 1st. Under Freddie and Fannie, I believe it's June 1st or June 30th. And they're kicking it off to December 31st. That's a significant change. They would be permitting servicers to offer certain streamlined loan modifications for borrowers with COVID-related hardships, this to avoid all the more complicated waterfalls required under normal loss mitigation procedures. Let's go to the next slide. Next slide, please. Thank you. There's also this now. I have to apologize on this slide. I said a proposed new interim final rule. It's not proposed. This is the problem when you write a slide late at night. It's a new interim final rule regarding evictions, and it impacts servicers with rental tenants on REOs or other properties. It says that debt collectors, and that's defined to include attorneys representing clients, must provide written notice to certain consumers of their protections in regard to the Center for Disease Control eviction moratorium, and prohibit misrepresentations about their eligibility for the program. The CDC has an eviction moratorium that relates to income levels. It's nationwide, and it essentially says that if you have income below a certain level, I believe the standard was $99,000 or less filing separately in 2019 for taxes, and 198,000 if filing jointly. And if you're receiving certain kinds of financial assistance, then you're eligible. And this now requires debt collectors, including attorneys, to deal with this. Again, this is a pretty aggressive move. There hasn't been a lot of talk about people being misled about their eligibility for the Centers for Disease Control, but the CFPB says they found some instances where people were being evicted despite this order. I'm not sure where that's taking place because an awful lot of states have eviction moratorium, but they said in their proposed in the rule that they've actually found some instances of this, so they've acted very quickly. Let's go to the next slide. I want to talk about some areas where they may be going fairly soon that they haven't acted on yet, but I think are priorities. One is FinTech. I think they, and Scott will talk about the DFPI in this regard, I'm sure, but the CFPB has also said that they're very concerned about FinTechs in this space, their relative lack of regulation and oversight. And so if there's some areas where I think they're going to focus more on FinTech, this raises issues for mortgage lenders and servicers in some ways. One of them is the administration as a whole has exhibited some hostility to the true lender issue and the interest rate exportation rules, and we've seen the OCC had tried to deal with that with some new rulemaking, but that's going to be slowly, I think, and pretty thoroughly regulatorily unwound to the extent they can, to say that go back to the older true lender analysis, which is based upon who really is bearing the economic risk weight of the transaction, not who's just the named lender on the document. And as a result of that, interest rate exportation becomes an issue, because if you're the lender and you're not a bank, you have all sorts of interest rate exportation limitations. If you're a bank lender and you're partnering with a fintech company who is actually doing a lot of the work on the loan and finding the borrowers and such, if you're what they call a rent-a-bank situation, you may find that this doesn't work. And while it's largely the fintech that's going to be in trouble, your regulators will not like that you're assisting in this, and you could face a lot of issues here. The next one is vendor management issues. Now, if the CFPB goes after fintech, that doesn't mean that you necessarily have, as a lender or servicer, would have direct liability or direct issues, but you have indirect issues in terms of your obligations to be responsible for the action of your vendors and to oversee and vendor manage them properly. If you're working in any way, whether it's sort of a partnership or you're using a vendor platform from a fintech company that is being aggressively investigated or has had problems with the regulators, your regulators are no doubt, out of safety and soundness concerns, going to be expecting you to address those issues and deal with them. So it's probably an additional area of vendor management and risk issue identification you need to start thinking about. Let's go to the next slide. So overall, what should institutions be doing with this new aggressiveness for the CFPB? It's largely a matter of beefing up your basics and doing things the right way. You should probably, a lot of institutions are already looking at and thinking about what are their potential problem areas right now, and they're doing deep dives on certain key areas to make sure that they get things cleaned up now. Again, everyone has their periodic reviews, but people are accelerating those and doing deeper looks at critical areas. As part of that, they're maintaining accelerating schedules for QC, QA, all sorts of testing and review. I think it'd be important to focus on processes and policies created in the last 4 years, given that those are areas where as your processes start to age and develop, you'll see issues, and they're still relatively new and people tend to make mistakes when they build out new things. So those are ones I would look at very quickly. I think you need strong compliance in general processes for your new rule implementations. That's an easy area for them to look at and find problems, because it's an area where you tend to make mistakes as you're learning your way along. And I don't think they have a lot of tolerance for mistakes when you're setting something up. Still very important to self-report issues, maybe more important than ever, and very important to fix issues as soon as they are spotted. You get credit for those kind of things, and if you don't, you can get in big trouble. That's always been the case, but given the return of the aggressive CFPB, it's as important now as it's ever been. Let's go to the next slide. Finally, and then if you do have exams, you've really got to do thorough examination prep. I've listed some ideas here. One thing I want to mention specifically is the third bullet point: train all people who examiners will talk to. This is something sometimes institutions don't do enough. A lot of people get in trouble because people at the lower level of the chain, who the regulators talk to about a specific question, tend to volunteer information. They talk about things they don't know about. Anybody who's been in-house, like Scott and I have, we're both nodding our heads because we've both seen that. You really need to train your people on what they're supposed to be talking about, what they're not supposed to be talking about, and what to say and what to do and what terminology to use, because regulators will chase you down rabbit holes if your people use mixed up terminology when talking to them and taking them down a path that is probably not an accurate place for them to be going. So I think that's all my slides on the CFPB. I'm going to turn it over to Scott so he can do the parallel analysis of what's going on with the DFPI.
Well, thank you very much, Michael. And yes, Michael is correct. We've worked together previously. Michael is amazing. So thank you very much for building me up in my intro. So yeah, I'm going to be talking about more of the state specific, as you can see, the CC, FPL, DFPI, and many, many more acronyms to come. If you can advance the slide, please. Dustin, can you move forward, please? Thank you. Oh, no, that's the end of the presentation. Does anybody have any questions on what I've done? What is the CCFPL? There we go. So it renames DBO to the Department of Financial Protection and Innovation, a new word salad to remember. It envisions a mini CFPB. It's modeled after the CFPB provisions in Dodd-Frank. It aims to strengthen consumer protections by expanding regulatory authority of DFPI. That's what they say. Also, like the New York version, which is the New York SDFS, it makes the agency independent, so not housed in the AG's office, which would be Pennsylvania's mini CFPB would be a model that would differ. It expands many of the DFPI's powers. So it expands UDAAP authority over covered persons and service providers, and we'll get into why that's significant in a little bit. Civil actions, it authorizes DFPI to bring civil actions to enforce the provisions of either Title 10 of Dodd-Frank or the CFPS's regulations under the department. And it's with respect to any entity that's licensed, registered, or subject to DFPI oversight. It expands their enforcement powers, and that's not just UDAAP, but also may enforce consumer financial laws as they relate to covered persons, service providers, and persons who knowingly or recklessly provide assistance to a covered person or service provider in violating consumer financial law. And I will say just at the outset, I live in Arizona. Palo Verde trees are blooming. So if I sound like death, if you don't understand me and need me to slow down, please say something in chat. Also, it expands consumer complaint authority. DFPI can promulgate rules around this, but they have to finalize their complaint response procedures first before they can start with an actual enforcement action against a covered person. They haven't done that yet, but they can make information requests and started doing that when DFPI officially became in existence, which was January 1st. Next slide. So what is the DFPI again? DBO, but no improved. Along with expanding the powers, which I mentioned before, UDAAP, civil actions, enforcement, and consumer complaints. They also get a brand spanking new budget. So it was a $100 million budget and 615 employees overseeing 360,000 individuals and businesses. Will expand, increasing the budget to $20 million and employees by 90 in the next 3 years, and a portion of that is already in Newsom's 21-22 budget. Next slide, please. Who does it cover? So this one is interesting. So you've got a couple of definitions, right? You have a covered person, includes any person engaging in offering a consumer financial product or service to a California resident, any affiliates of a covered person described in the subdivision, and then any service provider to the extent they offer or provide their own consumer financial product or service. Now, I say that knowing, going to the next slide, there's a big old hole you could drive a truck through as far as the exemptions are concerned. So there are exemptions, right? Yes, there are exemptions. And we have the ABA and some associated associations that have been working on this to thank for it. I think they were quoted as saying that really the importance is to make sure to shine a light on people who have not been under DBO's authority previously. So the exemption in 90,002 sub B states, this division shall not apply to a person or employee of that person to the extent that person or employee is acting under the authority of one of the following licenses, certificates, or charters issued by the DFBI. And it is a lengthy list. Finance lenders, broker dealers, residential mortgage lenders, mortgage servicers and originators, check sellers, any banks, bank holding companies, trust companies, savings and loan associations, savings and loan holding companies. I feel like I'm doing that old TV VCR repair commercial from back in the 90s right now, listing these. Credit unions or organizations subject to the oversight of the Farm Credit Administration, and then when acting under the authority of a license, certificate, or charter under federal law or the laws of another state. So as you can see, it's a pretty big carve out, which is good. The quote from the Bankers Association was, the changes we were advocating for, that the extent of the legislation be to cover current entities that are unregulated and there be no new enforcement authority over existing licenses, are now affirmed in these recent amendments. And I mean, you can definitely see that. Can you advance to the next slide, please? So here they are, if you want to take a look, but yep, it's a lot. If you want to take a screenshot, you can refer back, it is being recorded, but this is the very lengthy list of exemptions. These carve-outs for banks, other DBO licensees, means that they are actually going to remain subject to existing DBO authorities, even though all the DBO operations are now housed in DFPI. Can you move forward, please? So exemption on the new administrative actions under CCFPL. For most of us, not much is going to change, but there is a big group of people that are in the crosshairs, right? And I think if you've had any conversations leading up to DFPI coming into existence, you probably heard this from some of the staff at the former DBO of really wanting to get into a lot of the kind of emerging fintech areas that have been emerging. If you can go to the next slide, please. So who is covered? More than you think. Fintech firms, and I know that's very general. I'll talk about a couple of the actions that DFPI has been taking so far, which are pretty numerous considering it was 3 months ago that they came into existence technically. One of the big ones is, you've probably seen commercials where somebody says, I'd like to take my girlfriend for a date, but I don't get paid till Friday. But luckily with this app, I get $100 out of my paycheck. So those groups, companies in that app sphere, they are I don't want to say a big target, but that was a rapidly expanding segment. They're called EWAs, earned wage access products. So that's one of the big ones that's being brought into the fold under DFPI. Payday lenders, student loan servicers, and again, as I go into some of the enforcement actions that have gone on so far, that's one of them. Digital asset lenders, credit reporting agencies, and debt collectors. Next slide, please. So the actions so far. DFPI issued subpoenas to a dozen debt collection companies alleging UDAAP violations. That was their first major action since the CCFPL brought DFPI into effect January 1st. Actions based on consumer complaints. The consumers alleged that these debt collectors called repeatedly, failed to validate the debts, and threatened to sue consumers for debts they don't owe. Their next action, DFPI on February 3rd, announced its first formal enforcement action for 4 student loan debt relief companies. Alleged practices violated not only CCFPL, but the Student Loan Servicing Act. One specific company and its affiliates are accused of running a student loan debt relief scam. again, alleged, convincing over a dozen California residents and others outside of California to pay tens of thousands of dollars to wipe away their student loans. Wish I'd have known about that a few months ago. No, wait, no, it's not actually happening. Darn. DFPI directed the student loan debt relief company to provide refunds to 18 California customers by March 15th of 2021 and pay a $45,000 penalty to DFPI. The next one, the Office of Financial Technology and Innovation. That's the group that, we've talked about this new office and what really their purview would be. Is it just to explore these new emerging fintech areas and kind of help these nascent businesses move along and grow in a safe way, or is it really about trying to bring a hammer down on enforcement? Obviously, that remains to be seen, but the OFTI did sign MOUs with 5 companies offering those EWA products, the Earned Wage Access products I mentioned earlier, allowing them to continue to operate in California. So the companies agreed to a few things: provide quarterly reports to DFPI related to EWA product payment volume, fees, delinquency rates, and ratios of money. Advance to the paycheck, that ratio. Allow DFPI to examine its books and records upon 10 business days prior written notice to the companies, and then insert language into the EWA product agreements, making it clear that their EWA products are not licensed or regulated by DFPI, but may change in the future. Now, I want to stop here. I know that a few of these you're probably thinking, but Scott, I'm not an EWA company. Why do I care? And the reason I'm listing all these different enforcement actions is just to show you the creativity and scope of how they've been inserting themselves into these new areas, so that we can kind of all see where things are headed in California with the DFPI. And to Michael's point, obviously you're going to see a change from the administration previous, the Trump administration really wound down most of their enforcement efforts with CFPB, and it's why all of these mini CFPBs, as we call them in the States, it's really the reason for their beginning anyway. So good to know. On February the 4th, the DFPI issued invitations for stakeholders to provide input on rulemaking. So I'm sure you all got an email about this. They wanted to solicit things. There's a very broad scope in their request for information. The invitation asked for help on their definitions, exemptions, registration requirements, complaint handling, UDAAP, and that's for both consumer and commercial. Data collection and reporting for commercial financing, disclosures, and then clarifying applicability of California credit cost provisions. And then their most recent action, and this is one that's related more to our area, was March 31st, permanently barred James Jacob Berry and any company he owns or controls from seeking future enrollment as a PACE solicitor's agent. So I think you're going to see a lot of these kind of PACE actions, or as a PACE solicitor, after he discovered that he and his 3 companies misled consumers by marketing their products as a no-cost government-funded program. So I'm imagining a lot like back in 2008 when you had those ads for President Obama wants to help single mothers go to college. You saw those ads. It has that same kind of flavor to it. In addition to the barring, DFPI ordered Berry and companies to stop offering PACE financing to consumers and to stop using PACE in its business names, websites, marketing materials, or communications. And then I'll wrap up with their last action on February the 7th. In response to public comments, DFPI issued a red line modification of proposed regs on SB 1235, which is a law requiring consumer-like disclosures for certain types of commercial financing. And while that passed in 2018, it won't take effect until DFPI adopts the regs. So there have been 5 rounds of comments so far, and 4 sets, they're right there on the home stretch, and 4 sets of proposed modified regs since September 30th, 2018, as well as a public hearing in November of 2020. So as you can see, DFPI came into existence in January and they hit the ground running. This is 6 different actions that they've taken, or sets of actions they've taken really in the past 3.5 months. So we're definitely looking at a new breath of life, I think, into into what the regulator's looking to do, what they're wanting to get involved in the state of California. So while the exemptions are very broad and do really cover, you know, I would assume most of our member companies or even associated companies. That's right now. We never know what's going to change in the future, and so it's good to see what these actions are so the companies can be prepared moving forward. So that's it for my end. Thank you very much. We appreciate it. Now we can open it up to questions.
Where am I? There we go. Well, thank you very much, gentlemen. So I'm going to say that the theme seems to be that regulatory actions are going to probably be increased over the years, next year or two, both on the state and federal. I think that's not a surprise for all of us, but I think it's something, especially a lot of people on this call, on this webinar, you know, it's something they want to communicate to their leaders, because the last few years are like, look, it's easy, don't worry about it. And once again, I think it's going to come back, and we're going to have to address you. So I thank you for that. Dustin, do you have any questions that you can see?
Yeah, so if you've got questions for anyone on the call today, make sure to use that questions dialog box, and you can insert your questions there. We do have one right now, a question for Michael, asking him to explain a little bit more about true lender and interest rate exportation under FinTech, for example, which lending entity in the loan transaction is actually facing compliance risk in this area. Oh, Michael, I think you're on mute.
There we go. Thanks, Dustin. Yeah, as background, the true lender issue is a question of which of two parties who both are involved in the front end of loan origination is actually, for legal purposes, the true lender, carrying with, and that if you're a true lender, you of course carry with you lots of responsibilities under the regulations, but also certain benefits if you're a bank, particularly if you're a bank, because, for instance, national banks and other banks have the right of interest rate exportation from their home state as defined in several ways. And therefore, they don't have to worry about the usury limits in individual states. This is one of the reasons why you sometimes see, for instance, you know, major credit card banks issuing their credit cards out of South Dakota, which doesn't have serious usury limits. It's a big advantage for those banks, and would be a big advantage for other lenders who want to go national in scope or want to have higher margins on their loans. If you're a non-bank, though, you are subject to that regulation in every state. There's also questions about licensing. If you're not a bank and you're engaged in lender activities, you have to be licensed in every state you're working in. If you're a national bank, you escape that in many states, if not all states. And so there are a lot of advantages to being, to having the type of loan program you create between two parties, have a bank be designated as the true lender. And the type of groups that tend to create these kind of things are, it's not always fintechs, but it's often fintechs. You know, fintechs will recruit customers, potential customers, borrowers. They will create a program with the bank where they will do the underwriting as a servicing arrangement for the bank, and issue the loan in the bank's name, with the bank designated as the lender, but the fintech or other front-end processor has really done all of the work. And then oftentimes it's arranged where the fintech and the bank have an arrangement. This is true for many loans, not just for mortgage loans, where the fintech or other front-end processor takes on an abnormal amount of the indemnity and repurchase risk away from the bank, which is supposed to be the true lender. They oftentimes will say that if there's any early payment default, you know, whatever the definition is on the agreement, they end up paying for all that or doing the buyback. If there are buybacks for various reasons, they do it. If the bank suffers losses in excess of X, they will reimburse the bank. Sometimes it's if the bank loses any money, they reimburse the bank or the other party to the lending arrangement. It's not only banks that do this. This also became a big issue, and much of the law got developed from things that were known as rent-a-tribe, where tribes have similar advantages that banks do, and various non-bank lenders were partnering with tribes, Native American tribes, saying the Native American tribe was the, quote, true lender. those cases tended to unravel for those arrangements because the courts developed a series of tests, but they're fundamentally all centered around the idea of who's bearing the true economic risk, who's doing the work and who's bearing the economic risk. If you're the bank and you're really not bearing any economic risk at the end of the day, if you're going to be able to recoup from the other party that's doing most of the work, it's likely the other party is the true lender in an economic sense, and therefore becomes the true lender in a legal sense. And there's been a lot of litigation in this area. Some very serious penalties have come down, and it's a very serious matter because in some states, of course, for some types of loans, along with the penalties for usury, if you do a usurious loan, it can't be collected. You essentially lose the loan. Very draconian penalties. And so the OCC tried to get around this. Oh, and I should say that's how it leads to interest rate exportation issues. To get around all of this, the OCC last year, when Brian Brooks was the head of the OCC, and he had come out of first option one, and then bank, and then I believe it was option one. But anyways, he that later, I don't want to name the wrong bank. He came out of a West Coast bank, and then ended up with more recently out of a FinTech background. Pushed for two rules, one of which stated that the true lender, the OCC issued saying the true lender would be if the bank is named as the true lender in the document pursuant to an arrangement with another party, it's the true lender. And that's okay because banks have such heavy oversight obligations on their vendors. The OCC isn't worried about safety and soundness issues for the bank if the other party is doing most of the work. That's fine. So that rule takes you, if that makes the bank the true lender, then the interest rate exportation rights of the bank flow into the transaction. The other problem, there's another problem related to interest rate exportation, which is if a loan that is made by a bank is later sold, does the interest rate exportation rights still carry forward with the loan going forward? That's a whole separate issue, but that's also probably something CFP will get into. But for our purposes, for the discussion of origination, the issue is what I just said, is who is really a true lender, and what happens if the bank isn't a true lender. The reason it's a liability for the bank or other lender that's involved, that's not, say, the FinTech platform or the other party, is obviously you've got public relations issues, you've got goodwill issues with customers who think they made a loan with you, and it turns out they made a loan legally with somebody else who they never heard of, and then they discover the loan was made at a usurious rate in their state. You're going to get tainted with that, even though you may not face ultimate liability because you're not the lender. You're probably an aider and abetter, and to use a different kind of laws terminology, you will be found probably to have engaged in a UDAAP violation for having participated in a program like this, both at the state and federal level, UDAAP issues. And you'll have terrible safety and soundness issues, I think, with your regulators. And it's just not a place the bank wants to find itself. Nor do people who advise banks. There was a case, I believe it was in the DC Federal Circuit a year and a half ago or so, one of these rent-a-tribe cases, where in the very first paragraph, the judge made a point in the published opinion of naming the lawyer who had put this deal together for the tribe. That was a bad consequence for the lawyer. And so anyone involved in this in-house or outhouse, outside the corporation, is facing some real issues here. And it's a pretty serious matter. And the CFPB, and I think the DFPI, Scott will know more about that than I would, do not like these arrangements at all. And they look at them very closely. And I think they're going to look at them even more closely in the future.
And you brought up a good point with UDAAP too. Am I still on? Okay, now I'm unmuted. You brought up a good point with UDAAP too, and obviously I mentioned the DFPI is expanding the scope of what they can do with UDAAP violations, but we're starting to see that kind of everywhere. I know I think it's Colorado's privacy bill, they're starting to talk about a backdoor PRA, private right of action, utilizing UDAAP violations. So they're getting very creative in utilizing that for enforcing a lot of things that maybe they've questioned in the past, but now they've got the opportunity to. Yeah, I just want to mention this great point.
Scott, it's an interesting dynamic because the CFPB and the DFPI have charged with helping innovation as well as protecting consumers, because innovation can help consumers. But the fintech industry is a highly aggressive industry and works in some spaces that don't have a lot of rules around them yet, or don't have complete rules, or the rules, it's not clear how the rules apply. So there's a real tension between the desire to foster innovation and the desire to enforce the rules as they perceive them to be at the present. And I'm not sure where that's going in the long run. I think right now the tendency is to go in favor of enforcement as it is and punish anyone who deviates at all from the straight line.
Yeah, I agree. Like, I think that, they'd love to do more of the forward thinking kind of shepherding along, but with the perception of 4 years of there being no sheriff on the street, I agree with you. I think that's, we've got a little time before they start thinking that progressively, I think.
Yeah.
So basically, in a nutshell, it's not a simple issue. It's a lot of moving
Nothing
parts.
ever is.
I know, right? It's a lot of moving parts. Dustin, any other questions?
Nope, no other questions at the moment here. So I think we're right on time here to wrap up and give everyone a couple of minutes back of their day here.
Very good. Well, thank you everybody for joining. As you can see on the screen, we will have another Mortgage Quality and Compliance webinar next month, May 27th at 11 a.m. talking about marketing services agreements. So we hope to see you next month as well. So with that, Dustin, Scott, Mike, everybody, thank you very much for your time and thank you for attending.
Thank you.